Hello friends, welcome to Awdhesh Academy. Friends, now we are going to start a very interesting and very important chapter of GST, that is dealing with input tax credit. The knowledge of the input tax credit and the utilization of the same is extremely important because it reduces your tax liability to a very great extent. However, if you don't know the provisions and not able to use ITC properly, then it can have many penal consequences as well. So let us first understand what is the benefit of ITC or input tax credit. In the earlier regime, the provision of ITC or input tax credits were very restricted, because if you are transporting goods from one state to another state, then each state had its own VAT or cell tax laws. In that situation, it was not possible for you to take the credit of the taxes which has been paid in one state into another state. As far as the central taxes were concerned, it was freely allowed, but it was only limited to the central taxes and did not contain the state taxes. Under the GST regime, for the movement of goods or services all over the country, you can take the credit of input taxes, and that credit can be used to make payment of your final liability. So suppose your final liability is 100 rupees and your tax credit is 50 rupees, then you are required to pay only 50 rupees as GST. And that is the advantage now, that across the country and across all indirect taxes, now the benefit of this input tax credit is available. Another very important thing you should know is that a registered person is entitled to take the credit of input tax credit not when he is actually using it, but the inputs which has been purchased with the intention to be used for manufacture, production of a goods or supply of any services. So the use may be subsequent, but the credit benefit comes to you immediately. Another important thing is that the taxes which has been paid under the reverse charge mechanism, that means where the recipient himself pays the taxes, there also you can take the input tax credit. Now today we are going to learn about the important definitions which are relevant for knowing the input tax credit in a better manner. So let us first understand the definition of input tax credit itself, which is provided in section 262 of the CGST Act. It says, input tax in relation to a registered person means the central tax, state tax, integrated tax or union territory tax charged on any supply of goods or services or both made to him, and includes the taxes paid on specified categories of supplies of goods or services, both on reverse charge basis or on supplies received from unregistered suppliers. So what does it mean? It basically means it includes all type of taxes which are under the GST, that means central GST, state GST, integrated GST and union territory GST. Secondly, that all types of supplies where the recipient himself is liable to pay taxes, whether it is coming from an unregistered person or because the supply is covered under the reverse charge mechanism, in both the cases, whatever you are paying, you can immediately take the credit if it is available to you. Now, there are various terms which are used under the GST and under the input tax credit, and one of the very important term is capital goods. The capital goods means goods the value of which is capitalized in the books of account of the person claiming the input tax credit and which are used or intended to be used in the course of further business. The capital goods will generally means the plant, machinery and all those things will fall in the category of capital goods. Let's now understand the meaning of input. The input means any goods other than the capital goods which are used or intended to be used by the supplier in course or furtherance of business. So other than the capital goods, whatever else is used, that will be generally treated to be inputs. Normally the inputs will be consumed in manufacture of the process. In the manufacturing process, the inputs and input services will be consumed. But the capital goods will not be consumed, they will be machines which will be used for manufacturing the things. So that is basically the difference, that the capital goods are generally not consumed, inputs will be consumed. But capital good is well defined, and whatever is not covered under capital goods will be falling under inputs. Let us now understand the term input service distributor, which is given under section 261. Input service distributor means an office of the supplier of goods or services or both which receives tax invoices issued under section 31 toward the receipt of input services and issues a prescribed document for the purpose of distributing the credit of central tax, state tax, integrated tax or union territory tax paid on the said services to the supplier of the taxable goods or services or both having the same PAN as that of the said office. So let's understand the concept of ISD or input service distributor clearly. See, what happens that in an organization there are many services which are common for multiple units. Let us say you are a service provider and your head office is located in Delhi. However, your business is all over the country. So you place an advertisement which comes in the national newspapers. Naturally, the entire expenditure is made by the headquarters, but the benefit flows to all the units. And so what happens that if you take the credit, where you are going to use it? So for this, the government has made the provision of input service distributor, where if the input document is coming to you at the headquarters, you can distribute the credit to all those units for which it is related. It can be advertisement, it can be transport, it can be technology transfer, IPR related issues. So many things for which you are actually covering many premises, you have the provision that you can distribute the credit according to the different units which are having the same PAN number as the ISD. Now let us understand the concept of input tax. Input tax in relation to the registered person means this central tax, state tax, IGST, union territory tax charged on any supply of the goods or services or both made to him and includes the integrated goods and service tax charged on the import of the goods and the tax payable under reverse charge basis in CGST, SGST, IGST or UTGST, but does not include the taxes paid under the composition levy. That means when we are talking about the input tax, it includes all type of taxes, IGST, CGST, Union Territory GST and State GST. In addition to that, it will also include the IGST which has been paid under the Customs Act when the goods are imported. When the goods are imported, then you pay a tax in lieu of the IGST, and that also is included in the definition of input tax and you can take credit of that. But it does not include the taxes which are paid under the composition levy. Now let us understand the concept of inward and outward supply. Now suppose you are a manufacturer or a service provider. In that situation, what happens that you receive certain services or goods. Using that, you provide your final service or final supplies of goods or services or both. So whatever you are receiving, that will be called inward supply, and whatever you are providing, that will be called outward supply. So let us now go to the formal definition of this. Inward supply in relation to a person shall mean receipt of goods or services or both, whether by purchase, acquisition or any other means with or without consideration. The important thing to understand is that even if the supply is without a consideration, it will still be treated as inward supply. Now let's go to the definition of outward supply, which says in relation to a taxable person means supply of goods or services or both, whether by sale, transfer, barter, exchange, license, rental, lease or disposal or any other mode made or agreed to be made by such person in the course of furtherance of business. That means for outward supply, the business concept is important, that you should supply those things in furtherance of business, and it will cover all the modes as described in the definition. Let us now understand the concept of exempted and non-taxable supply. So first, the definition of exempted supply. Exempted supply means the supply of any goods or services or both which attract nil rate of tax or which may be wholly exempt from the tax under section 11 or under section 6 of the Integrated Goods and Services Tax Act, and it includes the non-taxable supply. See, all supplies of goods and services are covered under the GST laws, excluding those are beyond the purview of the GST laws. So for every supply there is certain classification, and against every classification there will be a rate. If that rate is nil, it will be treated to be an exempted supply. But even if the rate is there, but by any notification, that is section 11 of the CGST Act or section 6 of the IGST Act, if it has been exempted, in that situation what happens? That it will be treated to be a exempted supply. So either the rate is nil or it is exempted by a notification. In both the cases, it will be treated to be an exempted supply, and it will also include the non-taxable supply. So let us now know the definition of non-taxable supply. The non-taxable supply means the supply of goods or services or both which are not liable to tax under this Act or under the Integrated Goods and Services Tax Act. This Act means Central GST Act. So there are certain supplies, for example, alcohol for human consumption, which is not covered under the GST. The petroleum product, that is also not covered under the GST. So these items and these type of supplies will be treated as the non-taxable supplies. Let us now understand the concept of valid return. We know that the taxpayers has to file regular returns with the department. The valid return means a return furnished under subsection 1 of the section 39 on which self-assessed tax has been paid in full. So it is not sufficient that you file a return. You should have also discharged your full tax liability, and then only it will be treated as the valid return. Now let us understand a very important definition, and that is the definition of works contract. The works contract means a contract for building, construction, fabrication, completion, erection, installation, fitting out, improvement, modification, repair, maintenance, renovation, alteration or commissioning of any immovable property wherein the transfer of property in goods, whether as goods or in some other form, is involved in the execution of such contract. So the important thing about the works contract is that the works contract involves immovable property. It is relating to immovable property, because immovable properties cannot be treated as the goods. Goods are generally those which are movable. So anything which is related to immovable property, where some supply of goods is also involved, that will be treated as works contract. So friends, today we have learned about the important terms which will be used while understanding the concept of input tax credit, and I hope that you have got the thorough knowledge of the important terms which we shall be now using to understand how we can take the credit of input tax and how we can use it for payment of our final tax liability. Thank you very much for watching the video.